All right, let's pull back the curtain on the Canadian tax system, shall we? Today, we're going to look at a fundamental formula that's kind of hidden in plain sight, but once you see it, it changes everything about how you look at your income. So just take a look at this. We've got two taxpayers. In the real world, they both had the exact same result. They broke even, $0 profit. And yet, when it's time to file their taxes, one person has zero income for tax purposes, while the other is told they have an income of $200,000. Ouch, that's a huge tax bill.
So how on earth is this possible? I mean, it seems totally backwards, right? Well, believe it or not, it's not a mistake. It's a result of a very specific, very rigid formula that's buried deep inside the Income Tax Act, and we're about to crack it wide open.
To solve this little puzzle, first we have to get our heads around a key idea. The tax system doesn't see all money as being equal. No, it sorts every single dollar you earn into 5 distinct buckets. It's not just about how much you make, it's about what kind of money you make. And here they are. These are the only 5 categories of income the Canadian tax system actually recognizes. If your money doesn't fit into one of these buckets, like, say, a lottery win or an inheritance, it's usually not taxed. So let's just quickly run through what each of these means. First up, employment income. This one's pretty simple, right? It's the money you get from your job, your salary, your wages, all those other benefits. Easy enough. Next up is business income. Now, this one is super broad. It's not just for big companies. It's basically profit from any activity you do with the idea of making a profit. Even if it's just a one-time thing, like, I don't know, painting your neighbor's fence for some cash. Then we have property income. The best way to think about this is like, it's the fruit from your money tree. The interest, the dividends, or the rent that your investments generate. But here's the key. This is totally different from the profit you'd make if you sold the tree itself. And that is where capital gains come in. This is the profit you make from selling the actual asset, the tree. And what really matters here is why you owned it in the first place. For example, a tractor that a farmer uses to work his fields, that's a capital asset. But that exact same tractor being sold by a dealer, nope, that's business inventory. It's all about how the asset is used. And finally, we have other income. Now, this sounds like a big catch-all bucket, but it's not. It's actually a very short, very specific list of things. We're talking about stuff like pension payments, EI benefits, and money you pull out of an RRSP. It's definitely not a miscellaneous category. Okay, so we've got our 5 buckets. Now we can finally reveal the big secret, the official sorting formula. It's actually called the statutory scheme, and it's all laid out in Section 3 of the Income Tax Act. This thing is like the engine room of the whole system. And really, the best way to wrap your head around this formula is to stop thinking of it like a calculator. Instead, I want you to picture a giant, complicated sorting machine. You pour all your different kinds of income and losses in at the top, and it follows a really strict, step-by-step process to sort them. The order is everything. So here they are, the 4 main steps of the machine. First, under a rule called paragraph 3A, it adds up all your positive income. Simple. Then, in 3B, it deals only with capital gains and losses. After that, 3C lets you subtract a few very specific deductions. And then, and this is the big one, in step 3D, it subtracts your business and property losses. And this sorting machine basically runs on 2 fundamental, almost opposite rules. And these 2 rules are the key to our entire puzzle. First, capital losses are firewalled. They're stuck in their own little box, and they can only be used to cancel out capital gains. That's it. But business losses, they're like a superpower. Because they get applied at the very end of the process, they can swoop in and wipe out any kind of income that the machine has already tallied up. And hey, don't just take my word for it. Here it is, right from the Act itself. It says that capital losses can only be offset up to the amount that capital gains were realized. It's a really strict, unbending rule, no wiggle room. So now that we know these rules, let's circle back to our 2 taxpayers and see exactly why the order of operations in this sorting machine creates such wildly different results. This, my friends, is the aha moment. Here they are again. Remember, Situation 1 has a business loss and a capital gain. Situation 2 has business income and a capital loss. Same numbers, just flipped around. Let's run each one through our sorting machine. Okay, let's watch Situation 1 go through the machine. First, that $200,000 capital gain gets added to the total. But then, at the very last step, that superpower business loss of $200,000 comes in and just completely wipes it out. The result? Zero. Zero net income for tax purposes, or NIFTP. But now look at situation 2. The order is flipped and it's a total disaster. The 200 grand of business income gets added in first. Then, when the machine gets to the capital loss, bam, it hits that firewall. Since there are no capital gains to offset, that loss is trapped. It's useless. It can't reach back and touch the business income, leaving a final net income for tax purposes of $200,000. So, the final result for taxpayer number 1 is a nice, clean zero. That business loss did its job perfectly. But for taxpayer number 2, it's $200,000. The capital loss got stuck, leaving all that business income fully exposed to tax, even though, in the real world, their project was zero. That's the hidden formula, right there in action. So why does any of this matter? Well, because this isn't just some fun little tax trivia. This formula has a massive impact on real-world business and investment decisions. The type of income you plan to earn, and maybe more importantly, the type of loss you might risk, well, those are critical things to think about. And this affects huge decisions, like how you decide to structure a new business. For example, if you're a sole proprietor and your business loses 100 grand, that's a powerful business loss that flows right to you personally. But if you run that same business through a corporation, that loss is trapped inside the company. All you get on your personal return is a capital loss on worthless shares, which, as we now know, is way less useful. So just to finish the picture, that net income for tax purposes number we've been calculating, that's the big one. It's the foundation of everything. From there, a few other specific deductions are subtracted to get to your final taxable income, and that's the number your tax rate is actually applied to. But really, all the heavy lifting, all the real sorting, is done by that formula we just decoded. So the whole point is this: not all dollars are created equal in the eyes of the taxman. This statutory scheme, this sorting machine, it prioritizes and restricts different types of income and losses in a way that can have a huge impact on your wallet. So I'll just leave you with this question. Now that you know the formula, what kind of income would you rather earn? And maybe more importantly, what kind of loss would you rather have?